a little bit. Aaron Gibbs, Luke Lloyd back with us. Aaron, let's take a look first at what is driving the market comeback. We've made up all the losses from a couple of days ago thus far, and I'm wondering whether they're sort of resetting their big picture look, that every time you've doubted this market or there's been a fall off, you've been richly rewarded if you don't give up on it. It's happened again. Eventually that might not work, but it's been a pretty good method. How do you think it's playing out?
This was a very short, basically a COVID fear day that panicked investors. And I think a lot of investors didn't fully understand the positive implications of lower oil prices, even if it hurts the energy sectors. But once that information was sort of fully digested, investors were willing to come back in, and because ultimately they see the long-term growth of the U.S. So we will have those panic days. I'm sure there will be more ahead, but it just takes a couple of days for the fear to ride out and for investors to see the bigger picture.
How do you look at this market yourself, Luke? I've been reading about people like billionaire investor Leon Cooperman saying it's not really a rich market to him given the very low interest rates and the continued activity and the pickup from the pandemic. So he likes it. What about you?
Yeah, so talk about the Delta variant real quick. I said a couple of days ago that was just a temporary concern, and apparently the market believed that as well. 80% of adults right now are vaccinated. We always hear that 50% number, but that includes children, and we all know children aren't that at risk when it comes to COVID-19. So I think that was just an excuse to sell off a little bit. All we've done over the past year and a half is go straight up. And valuations, we're definitely stretched. We're at .com valuations right now. And that's because of the stimulus, we had over the past year and a half, either directly in people's pockets or either indirectly, like maybe the infrastructure spending. And then we have a strong reopening of the economy. 93% of the economy is reopened right now, and people are out and about spending money. And also at the same time, we have new money coming in. We see these meme stocks like GME or AMC. People who've never traded the market before or even thought about investing, they're pumping their money into the markets, which also is increasing these valuations. The thing is, Neil, this is not a normal year. 2021 is far from it, right? So we typically have 12 to 13% corrections in any given year. So far, we've only had 4% correction this year, top to bottom. I think we're going to land somewhere in the middle by the end of 2021. I think we're going to have at least maybe a 7 or 8% correction. I'm eyeing about 4,000 to 4,100 on the S&P 500. That's where you should absolutely unload your ammo.
Wow. By the way, when you say unload your ammo, what would you be unloading, Luke, in that environment?
Your dry powder, Neil. If you have 5-10% cash on the sidelines right now, the closer we get to 4,000 or 4,100, that's when you should start buying the dip even harder than you are now.
Okay. Aaron, let me ask you a little bit about factors that some of these companies can't control, even those reporting stronger than expected sales. I mentioned the chip shortage only because Daimler did yet again, saying that it could drag on longer than thought, maybe well into next year, maybe beyond that. Expects to see Mercedes sales impacted as a result, not because there aren't interested buyers out there, but because it can't deliver the cars. Is that a worry to you?
So the consumer area as well as the industrials, they've really been hit the hardest with a lot of the supply chain issues and the backups, as well as increased prices, costs that they can't pass on to the consumers. But when we look about 3 to 4 quarters out, it does look like a lot of these will be resolved. We've already seen some industries where it was easier to source materials, more like raw material agriculturals. Those have played out, and we've seen them kind of come up to almost normalcy. And it certainly looks like we're on track within 2 quarters to have these flushed out. But again, it's still very dependent on what other countries are doing, how they're handling the virus, and whether they come back up to speed. So it's concerning, but it still looks like a temporary 3, 6, maybe 9-month issue. And the American consumer is pushing that full steam ahead.
Guys, I'd like to get your take on this infrastructure negotiating going on in Washington. Negotiating might be a generous term, but Luke, it seems to me like the 2 of these measures are sort of joined at the, eye-popping hip here. And when it comes to just sheer money's involved, whether it's the $1 trillion infrastructure only package or the $3.5 trillion that progressives want to push on top of that. Let's say neither happens. Let's say they just, burn on the vine here, and we don't get either core infrastructure or any of this stuff that Democrats have been pushing in this larger measure. I think up to now the markets are counting on at least that core infrastructure package. If they get nothing, what will their reaction be?
I think it's going to have a short-term impact, a negative impact, but in the long term, I think it's actually beneficial. I mean, the thing is, I don't have a crystal ball. I think your first guest said, that they had a crystal ball. I don't have a crystal ball, but I do know that Democrats love to spend money. So I think we're going to get at least that $1 trillion moving forward. But the market doesn't like inflation, and it doesn't like taxes, right? So we got to pay for the infrastructure spending somehow, and that way is through higher taxes over the next 3 or 4 years. So in my opinion, I hope we don't get that infrastructure spending, because it's going to go towards all kinds of ridiculous, inefficient things like government spending always does, right? So I think that we need to keep in mind what is actually probably going to happen. We are going to get some infrastructure spending. The market is going to like that in the short term, but we are going to pay for it over the next 3 or 4 years, whether that be through inflation and definitely through our tax dollars, because we fund all of that.
You could flip it around too, Aaron, real quickly on the idea if we don't get the spending, we don't get the tax hikes to go pay for that spending, right? So if it looks like tax hikes of any sort are put off until next year, how would that be digested?
It's certainly a positive. Really, when you look at the estimates right now, even for companies that would specifically potentially benefit from the various infrastructure packages that have been thrown out there, it's very difficult for analysts to count on them and really build into their company business profiles because it's so unsure. And really, we just have a lot of economists that are discussing the benefits. It's not a lot of Wall Streeters that are discussing the benefits down to the company level. So it's still being very theoretical. And so I don't see Wall Street really reacting until we have a plan where we absolutely can figure out who it's going to hit the hardest, particularly with taxes. And so if neither one of these plans don't come through, Wall Street's going to be able to do just fine as they go, particularly if they don't have the increased tax hikes. Otherwise, yes, there's just going to be a little jostling as any new information has to get processed of how we have to do business.
Got it. Guys, stick around. I appreciate you.